Investors are very fearful that the growth of the U.S. economy and the global economy are going to slow down a lot next year and the year after that, and that there could even be a recession either in the U.S. or for the entire world economy. And that leaves them with a lot of major questions about corporate profits and the stock market, and right now they're not willing to buy or set a limit for these declines. For major indexes, this was the worst week for the S&P 500 since August of 2011, when the markets fell very sharply because of the debt ceiling crisis for the federal government. The Federal Reserve's projections for interest rates don't seem to have calmed investors down any. Some of them were concerned that perhaps the Fed isn't watching the state of the markets as closely as it could be, that it's not as concerned about the health of the economy as they are. But ultimately, it's hard to find one concrete reason for this decline. There are just a lot of concerns about what growth is going to look like with the trade tensions rising and all of these other issues. The government shutdown dominated a lot of the political news yesterday and today. That generally doesn't have a major effect on the stock market. It's obviously painful for federal employees if it lasts a long time. But since only parts of the government shut down, and since these things have to last for several weeks before people start missing their paychecks and adjusting their spending, it generally doesn't have a big effect on the markets or on the economy unless it drags out for an especially long time.